Robschild, no investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Thursday, August 8th, 2024. In today's episode, we'll start by going over the fact that the initial jobless claims came out, to my surprise, personally, because you know where I am if you've been watching the show. I'm quite bearish, and I keep expecting more bearish news, but this one little piece of data came out the other way. It actually came out a lot friendlier than expected. So the last reading of initial jobless claims, this is a weekly metric. How many people are filing for, not having a job every week? So the last weekly reading of this was 250,000. The expected was 240 instead of 233, and that gave a lot. That apparently was enough to send the stock market to go very bullish today. Very interesting. If you heard my show yesterday, I was convinced that today would be a bloodbath, but this was enough, apparently, at least for the short term. I don't think it'll hold up, but we'll see about that. In regard to Japan's basically bailout of the markets, I'm going to state that too many bailouts is inflationary in a bad way. I bring this up because it's another way of sort of looking at how fragile the markets are. And on Gareth Soloway's show today, if you saw it, he described it very well as, the markets are right now acting like, they had a hissy fit, essentially. It's like a baby crying. The markets were crashing because of the fact that Japan is saying, well, we're going to raise rates. And that's what happened. They said, we're going to raise rates, and the market immediately crashed. The Japanese stock market crashed 12%, and the U.S. market also crashed. It looks like the whole world was about to blow up because of a little hike in the Japanese yen. And I did talk about this yesterday, and it's just another way to look at it. And as being like, the market is so used to being able to get bailed out by the central banks that they're becoming badly immune. And if you have this go on for too long, you don't get that full business cycle of clearing out bad credit so that investments can properly function. And the longer term result of that is inflation in a bad way, where, this is the thing. If you have markets freaking out and then central banks saying, okay, oh no, don't worry, free money, here's more free money, what's that going to do? It's going to cause inflation. It's good for the price of gold. So I guess if you're holding gold, you'd be especially happy about the fact that this is happening. The market cries and the central banks march in and save the day. I don't think that the U.S. Federal Reserve is going to be so kind. I don't think they're going to beckon to the will of the whiny market. I would hope that they wouldn't. I think it would be really bad for them to do so. I think we need to clear out some bad credit. I think we need to go through this hard growing phase of, a full real business cycle. But that's just me and my crystal ball. Again, next Tuesday, Wednesday, CPI, PPI, inflation gauge comes out. That's next real, piece of economic data coming out soon. Also, daily reminder, 2-year 10-year yield curve is still past its second birthday. It's like 2 years and a month or so now. I'll have to check on that. SOM rule has been triggered. Recession has started according to that rule. So as excited as markets seem right now, this is a time to be especially careful in my estimation. Onto the charts. Obviously, as bearish as I was yesterday, nothing really typically goes down in a straight line. Like, think of even the COVID crash. It wasn't actually a straight line down. Every other day, it was a straight line down, and then a straight line up, and then a straight line down. It went down 10%, and then up 6%, 7%, like huge up days, while it was crashing. But even that quickly of day after day of going up and down is very rare, and I don't know if we're out in an all-out crash or not yet. But today was, any way you look at it, today was a bullish day. And, one very basic trend line to take a look at that's just blatantly obvious, high to high in the S&P 500 SPX, or whatever you want to call it, drag it down low to this candle here, basically. It would be very likely for us to touch this line and then get rejected off of it, just as a basic way of looking at this chart. When looking at a bar chart of the weekly time frame, each bar representing one bar, this is certainly not bullish looking. It's less bearish looking, especially since this is actually a green candle. But in no way does it look like we are in bullish mode. In order for the markets to get really bullish, we would actually need to take out the most recent high, which happens to be an all-time high of around 56.69 in the SPX. Now, volatility did cool off today, but not so much to uninvert the VIX futures curve completely. We're still elevated above the September contract. And when taking a look at the VIX on a daily time frame, this current day's candle still did not break below the giant green candle of Monday, which I'll call the Japanese Black Monday. Why don't we just call it that? And so volatility is still elevated and holding up here for now. And so this is overall still bearish looking. The CNN Fear and Greed Index is still in extreme fear. So this is the most bearish part of what we're looking at. When we go to the PY investing, I bring up this website sometimes because it shows sort of a longer term picture of where the market might be headed. We actually converted back into 100% stocks already and 0% cash, even though this is rating fear for today. So yeah, definitely with today's action, officially there's less bearishness for now than there was yesterday. I wouldn't describe it as bullishness, I'd describe it as less bearishness. Also notably, the September Fed meeting, now we went from a 72 probability of a double cut, 50 basis point cut, all the way down to 57%. So it's still the most likely scenario that we're going to get 2 cuts according to this metric, but the chance of 1 cut has risen pretty dramatically from 28% yesterday to 43%. I mean, what's changed? The main data that came out was the initial jobless claims coming out stronger than expected. And typically that number isn't super influential on markets, and so I'm guessing that the institutions are kind of giving retailers a little bit of false hope here and continuing to buy the dip. I mean, the more they do buy the dip, and then if it does go down, it's the institutions that are going to take more advantage of that motion. And so, with me and my crystal ball and all, that's what I kind of see is maybe happening here. Moving on to TLT, as you might know, I have something like 55% of my portfolio in this, although that number has been changing a lot lately with it going so high and dropping off here. I said yesterday that it looked like this it could be a bottom here and we could go up from here, but I don't know. It was more likely that we head to the scene of the crime, as they say, where they broke through this trend line to begin with. This is a very long-term inverse head and shoulders, and so as I stated yesterday, it would be very normal for us to actually test this line, and then there'd be tons of buyers of TLT and long duration treasuries waiting here and buying it before going much higher, which is what I'm expecting. TLT's duration is about 24 years, but I still like to use other ways of looking at this. The 30-year Treasury yield also has a chart which can be influential, and we actually hit a trend line today, and so this could mark maybe the bottom of TLT today. Moving on to TNX, the 10-year note yield. This one is also closely related to how TLT will perform. This one has not gotten back to its trend line yet, and so this adds more potential of downside. Again, it would be very, very normal to see TLT drop to this line. Right now it's priced at $93.60 a share of TLT. High yield corporate, I thought that today, if you've been watching the show, I have puts that expire tomorrow on HYG. Actually, it's not HYT, and they're out of the money, so they might end up expiring worthless tomorrow, or if the market crashes, then it'll be worth something and I'll be able to sell it at a profit. But anyway, enough about me. Today's candle was an inside day, and this is not actually bullish, this is actually bearish. When you have a large red candle and then the entire next day is inside of that candle, that's actually bearish. And so the expectation now, as far as chart reading goes, would be that it goes to the downside. Adding to the bearishness and looking throughout charts, you see a very similar looking chart in a lot of different charts. This is copper, COPX, copper miners, also inside day after a bearish candle. This is bearish. XHB, same thing. This is the home builders index, large red candle, inside day, bearish. The Russell 2000, same thing. Actually, interesting. That I don't know. Okay, don't worry about the line. This red candle here, inside day, as good as it felt to go up 2.4% in the Russell 2000 today, it was an inside day, and this is much more bearish than it is bullish. This is not, for this to look bullish, we would want to close above the top of this red candle here. So we would want it at 4 p.m., for example, tomorrow, to be above like 208 in the IWM, that ETF that represents the Russell 2000. Wood, same thing. The price of wood is a leading indicator I always like to check. Inside day of a bearish candle, looks bearish. Last few charts, MSOS is always one that I like to check. If you don't know, MSOS is it's a cannabis ETF, and it's where I like to look to see what the dumbest possible money is doing. And they got really excited today, which tells me, it's sort of a leading indicator of, where the retailer head is versus maybe where the institutions are. And this went up by 10% today, so good for those guys that are in this right now. I've been in this before, by the way, but when it was like $4 and it was like more obviously so dirt cheap that it was like impossible for me not to try to take advantage of it. But anyway, I digress. This popped up today, which actually for me is a bearish signal, not a bullish one. It just says that the dumb money is taking more risk than they should still. I mean, look at Bitcoin too right now, huh? Last chart of the day, KWeb. Before I even knew Gareth Soloway existed, I had KWeb, KWEB. It's basically the internet, maybe you could even call it the NASDAQ, more focused on internet companies like Amazon of China. And so it's the companies that are in this are, by most metrics, extremely undervalued, especially compared to their equivalents in the United States markets. Their PE ratios are just dirt cheap low. The risk here is just political risk, and if they invade Taiwan and American investors are forced out of investing in China, this could get worse. But I wanted to bring this up because Gareth Soloway today on his show said that, and I quote him, he said this could be the buying opportunity of the century, so of 100 years. He thinks that this, if it wasn't for the Taiwan thing. So if you're worried about China inviting Taiwan, this would not be a good investment for you. If you think there's a chance that it's not going to be an issue, then the buying opportunity of a century. So he pointed at, these are the same lines that he drew on his chart, starting back in October 22, with the bottom here touching January 2024, and so obviously a wedge pattern here, and we broke out of it and basically testing these two converging trend lines, and he sees a potential for a huge upside, and let me show you how much of a potential upside there is. So zooming out to a chart that shows each candle representing a month. This actually goes all the way back to 2014, where my mouse is over here on the left. You can see that the price of these companies has not been this low as it's been since 2022. Last time we've been even remotely near this range was all the way back briefly in 2015, and then before that all the way back in 2013. So while the S&P 500 has gone up a lot since 2013, this is the same price as it was in 2013, adding to the case of how crazily cheap this could potentially be. And the great thing with playing this is that getting a 100% return would actually be very conservative here. That would just be like it going from like absolute dirt cheap to like a little less dirt cheap. $50 a share would probably be still seen as dirt cheap. This is something that Benjamin Graham would be all over, by the way. Benjamin Graham in his books, the kind of godfather, grandfather of value investing, Warren Buffett, Michael Burry, all of the greatest investors attribute most of them attribute all of their success on Benjamin Graham. If you don't know about him, I go through the chapters of his books if you've seen my series. But anyway, he would definitely see this as a buying potential or investment opportunity of the century. Regarding political risk, again, he basically says don't worry about it too much. Businesses are businesses, and businesses run the world, and that's all there is to it. That's all I have for today's show. Hope you enjoyed. Thank you for watching. Robschild.